Thank you very much. Thank you, Chair Mulvaney, Ranking Member Schrader, members of the committee. As you know, I'm Angela Jackson, and I'm delighted to be presenting my testimony here today. I'm fortunate to be involved in the entrepreneurial ecosystem from several angles. One as fund manager of a professionally managed seed fund called the Portland Seed Fund. One as a chapter president of an angel group of private citizens getting together to invest angel capital. And third, as the director of the Portland State University Business Accelerator, which is a facility housing 25 to 30 fast, high-growth technology, biotech, and clean tech companies. In addition, I grew up in a serial entrepreneur household, and much like Mr. Schrader, got to witness my father betting the last $2,000–$3,000 on starting a company, which fortunately one day did have a nice exit and generate a lot of jobs and economic activity. I got to go to college off the earnings, for one. Like my father, many entrepreneurs do choose to bootstrap their companies, and in that case, they trade sort of a slower level of growth. This was a 20-year overnight success for the faster, explosive growth that you might achieve by seeking venture or angel capital, where you can accelerate that growth. So I look forward to answering questions later. I thought it would be helpful to talk about some things that are going on in Portland, Oregon, which is a real entrepreneurial destination. We are actually having entrepreneurs start to move to Portland to build their companies because of the quality of life, the access to tech talent, and the cost of living vis-a-vis other communities where they might like to be. So from my vantage point, things are looking good and getting better. Investors are coming back into the game. Startups are creating companies. So from the Portland Seed Fund standpoint, my partner Jim Houston and I raised $3 million in a hybrid public and private fund. $3 million doesn't sound like a lot by anyone's measure, but what we do is invest initially very small amounts of capital, $25,000 to start, in who we see as the highest potential, high growth, capital efficient companies that we can find in Oregon. We do these in classes or cadres of 8 at a time. And with the capital comes strings attached in the form of mentorship, intensive connections and investor introductions, as well as introduction to the ABCs of running a business. Very often these seed stage entrepreneurs come at it from the standpoint of the product, but they don't understand the other 9/10 of what building and running a successful business encompasses, and we expose them to that. To date, this is quite new. We kicked off the fund with our first investments last July, 8 at a time, and we did a second class just in early March. So 17 total investments is to date. Those companies, even after we just invested initial $25,000, have created 60 jobs and have gone on to raise over $4 million in follow-on priced capital. So we're very proud of the progress to date. But I also want to point out and set expectation. We are playing in a high-risk, high-failure rate asset class, the seed and angel class, and we know that failure is a key part of the game, and we do expect failures. So we call this the catalyst and the crucible. The discipline around what we do at the seed fund is, we think, what makes the difference in accelerating these companies' success. We take a similar approach at the Portland State University Business Accelerator, but the types of businesses that we serve are a little different, and they have a longer time to market. Bioscience cannot be a $25,000 overnight success, for example. So instead, we help these companies access larger formal rounds of capital, and we're proud to report that those companies were the subject of a Portland Business Journal lead article last November, something along the lines of what's in the water at 2828 Southwest Corbett. These companies have attracted $128 million in private capital to Oregon, which is kind of a cash-starved venture state, through their great work, and that was over a 5-year period. These companies are hiring rapidly. There's 15, these 25 to 30 companies have 15 open positions today. So these are, in fact, job-creating companies. The third hat I wear is with the Crowdfunding Forum, the angel group. And this is actually a global angel group, but I participate in the Northwest Circuit, which encompasses 240 members. Those 240 members last year invested $24 million of their own capital in 36 companies to grow them and to expect a return. I would sort of tap groups like Crucible Forum as a logical partner with the new crowdfunding legislation to put a face and a room to create an online-offline experience to vet out some of the deals, the due diligence and the deal screening that will be a necessary part of crowdfunding, which we are excited about, by the way. If I could wave a magic wand and ask for a couple of things, I am seeing that, first of all, we are supportive of the crowdfunding legislation. We also know, we're cautiously optimistic. We know that the devil will be in the details of rulemaking. So we're hopeful that process will go well, but it's early to tell. We're probably more excited about the easing of the non-solicitation ban in the short term anyway from Reg D, which will make it easier for the already in place angel infrastructure to advertise, attract, and recruit new members who, by the Crucible example, you can see are ready and willing to put funds into good companies. In the yet-to-do column, increased incentives to angel investors who are putting risk capital into place to grow the economy would be a top priority, as well as easing the friction through the tax code to startup companies who are struggling to create these jobs. And I know you're well aware of many proposals. I'm not going to suggest or back a specific one. A couple of other potential upstream choke points to be aware of. I'm not experiencing the easing of lending with the small companies that I work with yet. I would like to see some provision where the top performers, as vetted by groups like mine, can access loan capital earlier in the form of working capital and inventory financing. These are huge potential choke points to the growth that they could put on, and they're still, in my experience, struggling to get those loans. And I'm happy to talk to anyone who knows a way around that. And lastly, we are seeing a choke point of talent, actually. So the training, and whether we're training organically here or recruiting highly skilled tech workers to fill out these jobs that are becoming available. This is the new choke point that I'm seeing in the job-creating companies. So with that, I'm looking forward to your questions. Thank you.